Most people think they understand their money. They know their income, they know their savings, and they think they know what they owe. But there is one move, one completely normal, completely legal financial decision that can quietly reach into your tax return and pull out thousands of dollars you didn't even know you owed. And the worst part? You won't see it coming until it's already done. We're not talking about shady offshore accounts. We're not talking about tax fraud or loopholes or anything complicated. We're talking about something millions of ordinary people do every single year, something that feels completely harmless in the moment. And by the time they realize what happened, the damage is already locked in. That thing is a single, large withdrawal. Now, before you say, "I already know about taxes on withdrawals," stop, because that's exactly the trap. Most people think they understand this. They think they've done the math. They think they've accounted for it. And almost every single time they're wrong. Not because they're careless, but because the system was not designed to be understood the way most people think it works. Here's what almost nobody tells you. The United States tax system, and most major tax systems around the world, is built on what's called a progressive bracket structure, which sounds simple, and at the surface level, it is. You make more money, you pay a higher percentage. Most people learn that in school. Most people nod along. But here is where the understanding falls apart, and where the real danger begins. Your tax bracket is not just determined by your salary. It is not determined by your job income alone. It is determined by your total taxable income for the entire year. Every dollar that flows into your reportable income from any source, a bonus, a freelance payment, a stock sale, a retirement account distribution, all of it gets stacked. All of it gets counted. And all of it pushes that number higher. The IRS doesn't care why you needed the money. The IRS doesn't care that it was an emergency. The IRS doesn't care that you put that money back, or that you used it for something responsible, or that you genuinely didn't know. What the IRS sees is a number on a form, and that number determines what bracket you land in. But here's where it gets darker. And this is the part that almost no financial advisor sits down and explains clearly because, frankly, most people don't ask the right questions until it's too late. The real problem isn't the tax rate on the withdrawal itself. That's what everyone focuses on. Oh, I'll owe some taxes on that. Yes, you will. But that's not what wrecks people. What wrecks people is something called bracket creep, the invisible mechanism where one large sum of money silently pushes your other income into a higher tax category. Income that was already sitting there, income you already earned, income you thought you had a handle on. In other words, that single withdrawal doesn't just get taxed, it taxes everything else with it. Let me give you a real picture of how this plays out, because once you see it, you cannot unsee it. Imagine someone, let's call him David. David is 58 years old. He's been responsible his whole life. He has a modest salary, around $72,000 a year. He has a retirement account he's been building for decades. And this year his roof collapses. Not a small repair, a full replacement. And the contractor wants $35,000. David doesn't have $35,000 sitting in a checking account. Most Americans don't. But he has a retirement account with over $300,000 in it. So he does what feels like the logical, responsible thing. He calls his financial institution. He fills out the paperwork. He takes a distribution of $35,000. He figures he'll owe some taxes on it, maybe a penalty since he's not quite 59 and a half yet. He factors in a rough number in his head. He moves on. What David does not realize, what nobody told David, is that $35,000 just got stacked directly on top of his $72,000 salary. His total taxable income for the year is now $107,000. And that number didn't just change his tax on the withdrawal, it changed his tax on everything. His effective rate shifted. His deduction thresholds shifted. His exposure to additional taxes he never even considered, those shifted too. David thinks he pulled $35,000 out of his retirement account. What David actually did was quietly restructure his entire tax position for the year without knowing it. And when his tax return came back, the number wasn't what he expected. It was $11,000 more than he had mentally prepared for. Not $11,000 total, $11,000 more than his estimate. David had budgeted for taxes. David had tried to be responsible. And he was still blindsided, not because he was reckless, but because he was working with an incomplete picture of how the system actually operates. And David is not alone. Not even close. According to data from the Employee Benefit Research Institute, a significant portion of early and mid-retirement withdrawals result in tax bills that exceed the account holder's initial estimates. People aren't surprised that they owe taxes. They're surprised by how much. That gap between what people expect and what they actually owe is where financial stress quietly takes root in households that were otherwise doing everything right. Now let's talk about someone else. Because David's situation, as painful as it was, is actually one of the more straightforward versions of this problem. Meet Sandra. Sandra is 52. She's been investing through a brokerage account for years, and in one calendar year she decides to rebalance her portfolio. She sells off several positions that have appreciated significantly over time. The gains look good on paper. She feels smart. She feels in control. What she doesn't fully account for is that those realized gains are now sitting in her taxable income for the year, right alongside her regular salary, right alongside a small consulting bonus she picked up in the spring. By December, Sandra's total income on paper looks nothing like what she thought it would. Her accountant calls in February and delivers the kind of news that ruins a Tuesday morning. The mechanism is identical to David's situation. The source is different. The outcome is the same. One decision, made in isolation, quietly restructured everything else. And then there's the third version of this, the one that hits the hardest emotionally, because it comes from a place of love. A parent, let's say a mother, mid-60s, liquidates a portion of her retirement savings to help her adult child with a down payment on a house. She's worked her whole life. She wants to do something meaningful with what she's built. She pulls $60,000. She feels good about it. She doesn't feel reckless. She feels generous. And then tax season arrives, and what she receives is not a thank you note from the IRS. What she receives is a bill that eats directly into the gift she was trying to give, and then some. The money she gave away has now cost her more than she realized, in the year she could least afford a surprise. This is the emotional core of the problem. It's not greed, it's not ignorance, it's not irresponsibility. It's people making human decisions, urgent decisions, generous decisions, logical decisions, inside a system that was never designed to announce itself clearly. The system does not send you a warning before you pull the trigger. It sends you a bill after. So what do you actually do? Because information without direction is just anxiety, and that's not what this is about. The first thing, and this is non-negotiable, is that any withdrawal, any liquidation, any large financial move needs to be run through a total income projection for the year before it happens. Not after, before. You need to see what your income picture looks like with that number added to it, not just what that number looks like in isolation. This is not a complicated calculation, but it requires you to stop and ask the question most people never ask. What does this do to everything else? The second thing is understanding the concept of income smoothing. If you have flexibility in when you take a distribution, when you realize a gain, or when you receive a large payment, that timing matters enormously. Spreading a large sum across 2 tax years can be the difference between staying in your current bracket and jumping into the next one. The money is the same, the tax treatment is not. The third thing is withholding. If you do take a large distribution and you know it's going to create a tax event, you can request that a portion be withheld up front, similar to how taxes are withheld from a paycheck. It won't eliminate the liability, but it eliminates the shock of a lump sum bill in April when you've already spent the money. And the fourth thing, the one that ties all of this together, is the mindset shift that changes how you see every financial decision you make from this point forward. Stop thinking about money in single transactions. Start thinking about your tax year as a complete picture. Every dollar you earn, every dollar you withdraw, every gain you realize, it all lands in the same bucket. And that bucket has thresholds. Cross them, and the rules change. The bucket doesn't announce when it's getting full. That's your job to track. Here is the rule, simple, clear, and worth writing down somewhere you'll actually see it. A large withdrawal doesn't just cost you taxes on the withdrawal. It can cost you taxes on everything. Plan the full picture first, and you stay in control. React to the bill after, and the system has already made the decision for you. Your money is yours. The rules around it are real. But rules that are understood are rules that can be navigated. And the people who come out of this system with their wealth intact are not the people who earned the most. They're the people who knew what questions to ask before they moved. Don't be David after February. Be David before December. That's the difference.